Hello, my name is Anirban Basu. I'm an economist. Please hold any further applause. Our company's name is Sage Policy Group Incorporated, and we're out of Baltimore, Maryland. I want to thank the Bend Chamber of Commerce for inviting us and allowing us to talk about the economy, and of course, in conjunction with Damon. And I look forward also to the questions and answers session. And so let me begin with this presentation. It is entitled Return of the Economist. It is a Lord of the Rings themed presentation. You'll see this theming throughout the presentation. Now, there are many ways to begin such an affair. We could recite the Pledge of Allegiance, engage in prayer, which seems like a neat thing to do, or a thing that makes a lot of sense to do right now. And of course, we could sing the national anthem. But I want to start with that good old-fashioned American standby, the ring verse, which reads, 3 rings for the elven kings under the sky, 7 for the dwarf lords in their halls of stone, 9 for mortal men doomed to die, 1 for the dark lord on his dark throne in the land of Mordor where the shadows lie, 1 ring to rule them all, 1 ring to find them, 1 ring to bring them all, and in the darkness find them. You will see this theming, as I say, throughout the presentation. You know, whether you like it or not, I hope you don't hate it. But also this organizational framework, 9, 7, 3, 1. 9 rings for the kingdom of men and women, 7 for the dwarves, 3 for the elves, 1 for the dark lord. You may not agree with anything I'll say today, but upon one thing I think we can agree: the dark lord has been busy in 2020 here on Middle Earth, giving us, of course, COVID-19. Now, one of the keys to navigating through the crisis, I think, is to try to distinguish what to believe from what not to believe. And that's not that easy because we hear so much on an ongoing basis, including from public health experts. So one of the things I heard, and perhaps you heard something similar early in the crisis, was that the virus does not like warm temperatures. So the notion was that as we shut down the economy in March and April, that we should be watching out for months like November, December, January, and February. As those cooler temperatures return, the virus could come back with a vengeance. I don't remember anyone at that time telling me to worry about Florida, Arizona, Texas, New Mexico, Georgia in June, July, and August. But this map stands for the proposition that whether a nation is close to the equator or remote therefrom, the virus has impacted people wherever they live, whether India, Mexico, Brazil, or Oregon, Minnesota, Detroit, the Netherlands, Northern Germany, so on and so forth. Now, of course, it has really affected us Americans. This is a graph of COVID-19 daily cases back to March. You can see that we begin flattening the curve really in April, as you know, we've shut down the economy in March. And then we start to really see the flattening of the curve in April, and that lasts until mid-June. But then here comes the summer surge: Florida, Arizona, Texas, New Mexico, Georgia, so on and so forth. You can see that that surge lasts until the latter stages of July. We start to flatten the curve again, and that lasts until roughly Labor Day or a bit after Labor Day, and then a parabolic surge thereafter. And here we have November, December, January, and February, at least much of November still in front of us. So the pandemic lingers, and if anything, actually, it's worse than it ever is or was from a public health perspective. Oh, I know what people will point out to me, that death rates are lower. We now know that Gilead Sciences' drug remdesivir has clinical efficacy. Pfizer is making progress, as we know, and it's in phase 3 clinical testing for a vaccine. That's all true. But right now, the pandemic is with us. Now, one of the things I want to do is do some rewinding, because to try to understand how the pandemic is going to impact us during the months ahead, it makes sense to try to look at how it affected us when it initially hit the American economy. And in fact, there was some information that came out early during the crisis upon which we could rely. I will give you an example. On March 24th, the Federal Reserve Bank of St. Louis issued a report that forms the basis of this slide. And that report asked the question: as we shut down the economy, who is vulnerable to layoff? Now, I would argue to you that the crisis began economically on March 9th. And you say, Anirban, that is very specific, but also incorrect. They call this COVID-19 for a reason, and that's because it was discovered in 2019, whether in November or December of that year. Fair point. But I will say March 9th, because on that date, the Dow Jones Industrial Average falls more than 2,000 points, and at that time, that was a daily point decline record on the Dow. We set new point decline records, as it turns out, on March 12th and March 16th. And that's when we really became aware that this pandemic was going to be a major economic event, not something passing like SARS, MERS, or H1N1. So as I say, the Federal Reserve Bank of St. Louis economists considered 144.7 million jobs. If you look at the first bolded row here, employed in occupations at low risk of layoff, 54%. These include people in essential occupations like healthcare and construction, for instance. There are people who can work from home. We've discovered over the course of the crisis that about 37% of Americans can do their jobs completely from home. More on that later on in the presentation. If you look at the second bolded row here, employed in occupations at high risk of layoff. Well, who are these folks? Well, it's 46% of the jobs at high risk of layoff. And these folks include folks in food preparation. That's your restaurant worker. People in sales, that's your retail sales worker. So when you've got this kind of vulnerability, and March 24th is for the tail end of the first quarter, what happens after first quarters? That's right, second quarters. And the second quarter of 2020 was the worst quarter of our economic lives. Now, this is quarterly gross domestic product. All of the bars through this last blue-colored bar, that last blue-colored bar is the fourth quarter of 2019. And that's indexed to the left-hand axis. The first, second, and third quarters are shown in red-colored bars and indexed to the right-hand axis. I had to bifurcate the axes, which sounds and is, in fact, quite painful. Now, the recession begins during the first quarter. We begin to shut down the economy. We came into the year with plentiful momentum. We added more than 200,000 jobs in January, 251,000 jobs in February, but we shut it down in March. And in March, the U.S. economy shrinks 5% on an annualized basis, 5%. But that is the appetizer, because during the subsequent quarter, the U.S. economy shrinks 31.4% on an annualized basis. So when you've got that kind of vulnerability, meeting up with this kind of economic loss, you're going to get a lot of jobs lost in the economy, and I'll talk about that in just another slide or two. Now, as you know, during the third quarter, we experienced an unprecedented bounce back in economic activity, with the U.S. economy surging 33.4% on an annualized basis. Now, as it turns out, this economy is still about 3% smaller than it was a year ago, the national economy. So complete recovery is not yet at hand, of course, but pretty significant progress. And indeed, I would argue that the initial phase of recovery has been V-shaped. And I'll show you plentiful data on that as I go through this presentation, supporting that hypothesis that it's been V-shaped, or that assertion. But again, we have that kind of vulnerability. We have the second quarter, so that's going to translate into a ton of job loss. I'll talk about that in 1 second. Now, what is the hope here? The hope is that we can get back to where we had been economically, because where we had been, of course, coming to the year was a spectacular place. And if you're going to start with a discussion of the pre-existing momentum of the U.S. economy, I think you've got to start with the labor market. This is monthly job growth in America. Now, the blue-colored bars are through February of 2020. The last blue-colored bar here is February of 2020, and those are indexed to the left-hand axis. Again, I've had to bifurcate the axes. On the right-hand axis, March, April, May, June, July, August, September, and October of 2020. And why did I have to bifurcate the axes? Well, I'll explain that in a second. But in March, we lose 1.4 million jobs. That's when the recession begins, March. Well, actually, the recession data begun in February. The economic crisis really starts in March, but I'll explain more of this later on in the webinar. But in March, we lose 1.4 million jobs. And then in April, we lose 20.8 million jobs, which is why I had to bifurcate the axis, because if I tried to graph a negative 20.8 million on one unified axis, a lot of these vertical bars would just disappear. So during the 113 months ended with February, we added jobs during each of those 113 months and added 22 million jobs in the aggregate. In March and April, we lose 22 million jobs in the aggregate, wiping out all the jobs that we added on net over the previous 113 months. In some sense, we had to do a start over. And economists surveyed by the Wall Street Journal, mainly economists who work for large US financial institutions, collectively predicted that we'd lose another 8 million jobs in May, but we didn't. We added 2.7 million jobs in May, followed by 4.8 million jobs added in June, and then 1.8 million jobs in July, and nearly 1.5 million jobs in August, and more than 600,000 jobs in September, culminating with October, 638,000 jobs. Pretty impressive. Now, don't get me wrong. Even though the initial phase of recovery has been quite brisk, we are nowhere close, of course, to complete recovery on a year-ago basis. So if you compare October 2019 data versus October of 2020, we're down 9.2 million jobs. Now, which sector of the economy has lost the most jobs? Leisure and hospitality. That's your hotel worker and your restaurant worker, down 3.3 million jobs. But you'll note that every major sector of the economy has lost jobs on a year-ago basis. Again, October 2019 versus October of 2020, and we're down 9.2 million jobs on a year-ago basis, and about 10 million jobs or so since February. What about Oregon? Beautiful state, as it turns out. Glorious state, actually. I am particularly fond of the Oregon waterfront, but I've given speeches in Bend, Oregon as well, and I'm also very fond of Central Oregon in any case. Oregon, over this last 12 months, for which we have data, so that's for the 12-month period from September 2019 to September 2020. The state level employment data are not yet available for October. The state lost 132,700 jobs, or nearly 7% of its job totals. And which sector lost the most jobs? Leisure and hospitality. Of course, Oregon is a major state for visitation, to visit, of course, not just Bend, but Portland, Oregon, and the waterfront communities. 53,400 jobs, more than a third of jobs lost in that one segment. Manufacturing losing 17,800 jobs. But again, you can see a widespread damage done to the economy. Every major sector of the economy, including construction, losing jobs. You might say, well, Anirban, that's Oregon. What about Bend? Beautiful Bend. Bend, Redmond, Oregon, that metropolitan statistical area, losing 6,200 jobs, or 7.1% of job totals. So the pace of job loss in Bend has been sharper than in Oregon or in the United States. Does that surprise anyone here? It shouldn't, because of course Bend is a major center of visitation. So that's your leisure and hospitality and retail segments, all of which have lost jobs over the course of this downturn. We can show you, or I can show you more regional economic data. This is employment growth for the 25 largest metropolitan areas in America. But it's really a mistitled slide, isn't it? Because there is no growth here. Growth should be in quotation marks. That said, some regions of the country have lost fewer jobs than others. So again, this is for September 2019 versus September 2020. Which region among the 25 largest has lost the fewest jobs? Well, that's Phoenix, Mesa, Scottsdale. Who's the governor of Arizona? A guy named Doug Ducey. Doug Ducey has been one of the most aggressive in trying to keep his economy open. The same can be said for governor of Texas, Greg Abbott, and the governor of Georgia, Brian Kemp. Brian Kemp was the first to reopen his economy, happened on April 20th. So some governors have been more focused on the economic outcomes. Some have been more focused on the public health outcomes. I'm not suggesting there's a right or wrong answer there. I'm just saying that those policymaking decisions have economic implications. Where have we seen the most job loss? Well, you see at number 25, the New York metropolitan area. Who's the governor of New York? Andrew Cuomo. Of course, New York emerged as an early stage viral epicenter. And of course, many New Yorkers commute to work using mass transit. So if you keep the economy open, but let's say shut down mass transit, a lot of people who use mass transit will lose their jobs. The people who get to keep their jobs have cars. And that would further widen socioeconomic disparities. So, to avoid creating such issues and to try to reduce the spread of infection, New York City shuts down very aggressively, as does California. Who's the governor of California? Gavin Newsom, your neighboring state, of course, himself a very handsome gentleman. He could be a Hollywood actor, but he's been very aggressive in keeping that economy shut down. San Francisco, Los Angeles, Riverside, San Diego, all with significant job loss. And then you see Portland there at number 17. And Oregon, as has been the case with the entire West Coast, has been pretty aggressive in trying to deal with these public health issues and trying to reduce the curve of infection. What about unemployment? Unemployment begins this crisis at 3.5%. And, that was a 50-year low. You'd have to go back to December of 1969 to find unemployment as low as it had been pre-crisis. And just to give you a sense of how long ago that was, the Orioles were good back then. The Orioles were good back then, and I know these things. I'm from Baltimore. Now, by April, unemployment is at 14.7%. Here I'm giving you some additional granularity. We've graphed overall unemployment in red, men in blue, women in green. So April, 14.7%, but probably the active rate of unemployment was higher than that at its peak because there was some statistical mismeasurement. And the so-called reference week in April was pretty early in that month. So some of the unemployed people or people who became unemployed during that month were captured in that unemployment rate data. So my very strong belief is that at the peak, the unemployment rate in America hit around 20%. I can never prove that to you, but that's my conjecture. In any case, since that time, unemployment has fallen, and by October down to 6.9%. And if you flip this line upside down, why would you do that? It's because less is more. The lower the number here, the better. So if you flip this line upside down, you would see the letter V. Because again, the initial phase of recovery has been quite sharp. Again, we can show you regional economic variation, again, for the 25 largest metropolitan areas in America. You see the Portland metropolitan area with a 7.7% unemployment rate as of September. So the nation that month was 7.9%, Portland was 7.7%. If Portland Metro followed what happened in the nation in October, then the unemployment rate in Portland is probably less than 7% as I'm speaking to you now. Again, I don't know that. We're waiting for the data, but that's a conjecture. Now, where do you see the lowest rate of unemployment? Among the 25 largest metropolitan areas in America, St. Louis, who's the governor of Missouri, a guy named Mike Parson. Mike Parson has been very aggressive in trying to keep that economy open. Where do we see the highest unemployment rate? That's in Los Angeles. And of course, Gavin Newsom, governor of California. Now, you might say, Ani, but I see something strange here. You know, I see Tampa at number 3. That's Governor Ron DeSantis of Florida, been very aggressive in keeping that economy open. But I see Orlando at number 20 with a 9.8% unemployment rate. Same state, what's going on? Orlando. What is Orlando about? Leisure and hospitality, retail trade. It's about Disney and Universal Studios. So not just public policy matters, obviously, but so too does the structure of these regional economies. Some regions have more white-collar workers able to work from home. Some are more blue-collar in orientation. Some have larger leisure and hospitality sectors. So there's an admixture of factors at work shaping these data. What about wages and salaries? Do you remember what the principal complaint was among chamber members and other American businesses coming into this crisis? My guess is that your principal complaint was can't find workers to support growth. So construction firms have told me repeatedly, or construction firm operators, I can't find carpenters, I can't find electricians, I can't find plumbers, I cannot find heating and air conditioning professionals, I can't find roofers, I can't find glaciers, I can't find superintendents, and I sure as heck can't find estimators. And manufacturers say, I can't find machinists and I can't find welders. And a good welder can make low 6 figures in this country. Where are they? And trucking firm operators will say, I can't find drivers. Everyone knows I can't find drivers. They may not also know that I can't find mechanics. So this is growth in wages and salaries as measured by the U.S. Employment Cost Index. And what it shows is that pre-crisis, people were making more money. So what have I said so far? More people on the job, more people making more money on the job. And what do Americans do when there's some extra money in their pockets? That's right, they spend it. They put stuff in the wagons. This is retail sales. Now, retail sales begin to slip in February, which probably is one of the reasons that the National Bureau of Economic Research has decided that the recession began in February. But then retail sales, if you look here, fall off the table in March and April as we shut down the economy. That's predictable. But then what do you observe again, ladies and gentlemen? A sharp bounce back. By May, retail sales are rising. Again, we added 2.7 million jobs that month. The economy is coming back to life. And by June, retail sales are above their pre-recession highs. Now, some rewinding is in order. What's going on? On March 27th, Congress passes the CARES Act and the president signs it. So that's $1,200 checks to certain American individuals. Some people start receiving unemployment insurance benefits of $600 each week from the federal government on top of their state unemployment insurance benefits. So money is pouring into households, or at least certain households, but people can't spend it. The malls are closed, restaurants are closed, and there's only so much Grubhub you can order. Now, as the economy reopens, that cash starts hitting the economy. May, June, stronger retail sales, and that continues through September, the latest data point I can show you today. So again, if you use your imagination, you might be able to spy a V-shaped recovery there. Again, you'd have to use your imagination. But what was the miracle of the economy as it had been? The miracle was not that 50-year low in unemployment. I don't think. That was impressive. The miracle was the lack of problematic inflation. Now, here's another issue here. One of the things that's been happening is that Economists and others have been looking at high-frequency data because things are changing so quickly. We're impatient when it comes to monthly or quarterly data, just to get the job done always. So these data come out each and every day. This is open tables, restaurant reservations, seated diners. Graph back to February of 2020. Now you can see this is a year-over-year percentage change. So we go to negative 100% by March. We shut down the economy. Now my staff of mostly 20 and 30 somethings put this together, and they took the y-axis down to negative 120%. I'm probably going to tell them at some point you can only go to negative 100%, but set that aside. You can see a rapid recovery starting in May into June, and then what happens? The progress flattens out. And that's that elevated infection rate in June, July, August, not because we're really aggressively shutting things down again. It didn't happen in Florida and Georgia and Arizona, but because people pulled away from the economy. So that's important to note, that even absent state-mandated social distancing directives, people will on their own pull back when they see viral spread, aggressive viral spread. Now, you can see that big peak there, if you look at the series, is Labor Day, as it turns out. And then things again have once again flattened out just a bit in terms of progress. And one of the reasons for that is that the virus is spreading rapidly once again. Now, again, I'm trying to get to the miracle, low inflation. So one of the things I had been taught in school, and many of you were told something similar, I'm sure, is that when unemployment goes down, inflation goes up. Phillips curve. And when I was tested on that in college, it was not a multiple choice question. It was not, Anirban, when you hear that when unemployment goes down, inflation goes up, what feelings, are you sensing? Please write them down for me. What emotions you're sensing, please write them down for me in excruciating detail. I'm very interested in reading about that. No. It was true, false. Anirban, inflation down, unemployment down, inflation up? Yes, professor, true, done. So if I point out that we had a 50 lower unemployment, and I remind you that the Federal Reserve bolsters its balance sheet during the previous crisis, the Great Recession, from $800 billion pre-crisis to $4.5 trillion during that crisis, you might say to me, Anirban, with all that money supply creation and with low unemployment, we're going to have an inflation problem in America, but we didn't. This stands for the proposition that inflation was running between 1.5% and 2.5% per annum prior to the crisis. Well, that's just perfect. The Federal Reserve's target is 2%. In fact, the Federal Reserve has been so unconcerned by inflation that last year they cut rates not once, not twice, but thrice, even as we marched toward that 50 lower unemployment. Now, one of the implications of lower inflation is lower interest rates. This is the yield on the 10-year Treasury, the most liquid bond in the world. But interest rates have been low. So a perfect setup of low unemployment, low inflation, low interest rates, many implications to this recipe or this formula. One of them is rising home prices. It should be of surprise to precisely no one in this audience that home prices were rising prior to the crisis. Well, of course. I mean, the inventory of unsold homes was low, haven't built many new homes in recent years. Demand is high, mortgage rates are low, and creating lots of jobs. But what might be somewhat remarkable is that the pace of home price appreciation has accelerated over the period of crisis. Mortgage rates have fallen even further during the crisis. More people want a social distance. More people want to look good on GoToWebinar or Zoom, so they want room for a home office. And of course, millennials are coming of age. Many of them are now in their 30s, and many others are approaching their 30s. So instead of renting an apartment, as they might have done 4 or 5, 6 years ago, they're more likely to buy a house. And as I say, the inventory of unsold homes is low. So home builder confidence hit an all-time high in August. This is U.S. residential building permits. It's a leading indicator. You've got to pull a permit before you can build anything. So coming into 2020, you see a surge in residential building permits. Then, of course, during the crisis, early stage of the crisis, permits fall. But then what again do you see here? A sharp bounce back in residential building permits. Again, if you use your imagination, you can see the letter V. So as I say, home builder confidence was at an all-time high by August because they can see what's happening. They can see that there's not much supply out there. There's lots of demand, prices are rising, and they're chasing after that market, that unmet market, and after those higher valuations. And then finally, the stock market. You're trying to establish that pre-existing equilibrium that we enjoyed coming into the year. So the Dow Jones here is indexed to the right, the Nasdaq and the S&P to the left. As it turns out, during the date of November 10th, we heard that announcement from Pfizer suggesting that they are doing very well in their phase 3 clinical testing, recording more than 90% clinical efficacy. So wonderful. And so it would appear that a vaccine is part of our future. I entitled this slide, but it goes to Elvin. To pay homage to the fact that Lord of the Rings has lots of bells, but also to fully understand the title of the slide, you'd have to harken back to a movie that came out in 1984 called This is Spinal Tap. And if you understand that reference, this becomes hilarious. But if you don't worry about it. The point is, all systems go coming to the crisis. A terrific job market, right? Lots of job growth, low unemployment, faster wage growth, more retail sales, stock market appreciating, home prices appreciating. In fact, the economy had so much momentum coming into this period, into the period of the pandemic, that some economists, prominent economists, reported in prominent newspapers as late as early March, indicating that we might be able to get through this public health crisis without a recession. That was enormously naive for two reasons. Let's talk about those. First, though there was lots of momentum, coming into February economically, and so the economy appeared to be an irresistible force, it wasn't so irresistible. Over the course of 10 plus years of economic expansion, some vulnerabilities had built up in the economy. Let's talk about those. So one of these vulnerabilities or fragilities is that not all segments of the economy were fully participating in the economic expansion. I'll give you an example: agriculture. Many farmers have had to take on lots of debt, including from non-traditional lending sources, because they've been dealing with trade wars, low soybean prices, low corn prices, monopolistic buyers. Manufacturing was a sector that was in recession just before the onset of the pandemic. This is the Institute of Supply Management's Purchasing Managers Index. You see the 50-yard line running west and east across that slide. Any reading less than 50 means that manufacturing is in recession, which it was for 5 months late last year. Why? Trade wars. Weakening U.S. auto sector, which really peaked in terms of activity in 2016. Strong U.S. dollar, which among other things frustrates U.S. export growth and invites in more imports. And then the issues at Boeing with its 737 MAX. Something of great interest, of course, to folks in the Pacific Northwest. But lo and behold, what happens late last year? We get ratification of the USMCA, the US-Mexico-Canada Trade Agreement. We get a first phase trade deal with China, and we get Boris Johnson's resounding victory in the United Kingdom, which for a time gave us more certitude regarding Brexit and its economic and political implications. So some of that uncertainty revolving around the US manufacturing sector began to abate, and manufacturing, very briefly, January of this year comes out of recession with a reading of 50.9. Then, COVID-19, global supply chain disruptions in Asia, Europe, elsewhere, and of course a shrinking global economy, and manufacturing is back again deep in recession. And then what do you see? Again, a sharp bounce back in economic activity. You see the letter V quite literally on this chart. Why is that? Again, rewind. Manufacturing plants, General Motors, Ford, Chrysler, Boeing shut down. Can't build inventories. People are shuttered at home. But they're receiving checks, some people, $1,200 checks, unemployment insurance. They're stockpiling cash. Not everybody, but some families. As the economy opens back up, that cash hits the economy, and there's a need to rebuild inventories. That's what you see here. But again, my point in showing you this slide was not that so much as to point out that pre-crisis, manufacturing had some vulnerability, some fragility. But by far, the leading source of vulnerability relates, I think, to debt. For instance, the national debt, which came in at $23.5 trillion as we entered the crisis, and is now over $27 trillion. Now, this comes from the Congressional Budget Office. You see the dark blue-colored bars at the end of the series forecast for the federal budget deficit as a percentage of GDP for the next 10 fiscal years. Last federal fiscal year, which ended on September 30th, we ran a $3.1 trillion federal budget deficit that was equivalent to 15.2% of GDP. So, and one of the issues here in terms of negotiating new stimulus is how much more can we afford to spend when our national debt is already so high? And that puts, that ties at least one arm behind our back because we can't fully respond to this crisis. can't fully meet needs. But that's not where the debt story ends. Household debt had never been greater than it was coming into the crisis. Here I'm showing you various flavors of household or consumer debt. Mortgage is in orange, student debt is in red, credit cards are in blue, auto loans in green. So yeah, a lot of families said, oh, I got to make rent this month early in the crisis, but then it's hard to make rent when you've also got a student loan coming in through the transom, or an auto loan to pay, or credit cards to pay. Another source of vulnerability. So what appeared to be an irresistible force was not that irresistible. It had some fragilities. And corporate debt had never been greater than it was prior to the crisis. You say, Anirban, how is that possible? You just showed a slide with a booming stock market. And I know, and I have seen that corporate earnings have been strong. And did we not cut corporate taxes in late 2017? Yeah, check, check, check. You're right about all those things. But you can do a lot of things with cash. Let's say this was, let's say I was Oprah Winfrey, and this was a live studio audience. And it's toward the tail end of the show. I've just interviewed, I don't know, Arsenio Hall. I don't know. The point is, it's end of the show, and I say to you, hey, everybody, look under your seats, $40,000. And then you say, I love Oprah. This is a great show. This is a great show. Now, there's a lot of things you could do with that $40,000. You could pay down some debt. But you could also use it as a down payment on your C8 Corvette, which is what I would do. So, and one of the things the companies have done is to buy back their shares. So they've taken that cash, leveraged it up, and then bought back shares. And you understand the game. You're chamber members. You reduce the number of shares outstanding. Earnings per share goes up. That tends to drive up the share price. Everyone's happy, but you're left with a more leveraged balance sheet. And if you buy, for instance, your leading competitor or the technology company with the latest platform, that would also tend to drive up debt to the extent that deals are financed with debt. So the biggest year for mergers and acquisitions during this latest cycle was in 2017. The biggest year for stock repurchases was 2018, which is the year after we cut those corporate taxes. So again, another source of vulnerability, but that's not where it ends. What about worker productivity? Now, when I was growing up, I grew up in Kankakee County, Illinois, on the Indiana border, and yes, every bit as exciting as it sounds. But when I was growing up, people said to me, Anirban, America is a 3% country. That's how fast we grow in real terms. We're a 3% people, 3%, baby. Just economists like myself, how fast we'll grow going forward, setting aside COVID-19, I'll say less than 2%. Not because I lack patriotism, but because macroeconomically, economic growth is simply labor force growth plus productivity growth. So pick up the third bullet here. U.S. productivity has risen at an average rate of 1.6% since 2007, compared with a 2.2% average since the end of World War II. Productivity is not growing the way it once did. And one of the reasons I think is generational. Baby boomers are a wildly productive generation, but more of those workers are retiring from logistics, manufacturing, construction, accounting, so on and so forth. So, and then the labor force is not growing the way it once did, because immigration policy has shifted. We haven't had as many babies in recent decades. And at 1.73, America's fertility rate is the lowest on record. And again, baby boomers are retiring in large numbers. Now, it is true that during the second and third quarters, productivity growth takes off. That is statistical aberration. What's going on? There's a correlation or correspondence between productivity and wages. The higher the wages, the higher the measured productivity. So who got averaged out of the data during the second and third quarters? Disproportionately workers in retail, trade, leisure, and hospitality. Those are near entry-level or entry-level jobs, lower wages often. So as they got averaged out of the data, productivity looks stronger for the workforce, but it is just statistical. It's not real. The fact of the matter is productivity growth in America has been quite weak in recent times. But there's more, structurally speaking. I know right now you and I are fixated on COVID-19, and well, we should be. But there are other issues out there. I mean, this is the Global Economic Policy and Uncertainty Index. Now, I've graphed it for you back to 1998, and not arbitrarily. So lots of risks coming from various parts of the world. There's still North Korea, there's still Russia, there's still Iran, so on and so forth. There's still Italy, and most people can be very rude. So I've graphed this back to 1998. What was the big issue in 1998? Do you remember 1998? Do you remember what the big issue was back then? Oh, what's that? You're embarrassed to talk about it? You're getting a little hot under the collar? You're blushing? Let me say it because I'm your speaker, it's my job. I'll tell you what the big issue was in 1998. It was Monica Lewinsky there said, but she was hardly a threat to the geopolitical structure of the world. But then what happened 3 years after that? 9/11, followed by 2 major wars involving the Americas, then the 08-09 global financial crisis, then the 2011-2012 European sovereign debt crisis, and then trade wars, and more trade wars, and then COVID-19. So again, all of this vulnerability existed as we marched into 2020. What seemed like an irresistible force was not that irresistible. And then finally, I would argue to you that asset prices were high coming into this period. This is the Shiller price earnings ratio. So what I'm trying to do for you here is I'm trying to juxtapose the price of shares on the S&P 500 vis-a-vis their underlying corporate earnings. And all I'm trying to say here is that the price of shares was high coming to the crisis. Again, you can see the V-shaped recovery as the markets bounce back. Not as high as in March of 2000, just before the dot-com bust, but high. And what goes up can come down. What goes up a lot can come down a lot. Now, don't get me wrong, a significant fraction of the bull market we observed during the previous decade was perfectly justifiable on macroeconomic grounds. Some very special things happened and did not happen during the previous decade. What did not happen? We did not have a recession. It was the first time in American history we went an entire decade without a recession. What did happen? America's share of global output rises. For decades, America's share of global output has been in decline. And some of that has been engineered. By whom? The Americans. It's Americans who fashioned the Marshall Plan to help rebuild Europe post-World War II. It's Americans who spent some of their own treasure to accelerate Japanese economic recovery post-World War II, with the goal of trying to transform our sworn enemies into our future trading partners, and boy, did it work. Today, Germany is the 4th largest economy in the world, Japan is 3rd, Italy is 8th. But as this is something very special happened in the previous decade, our share of global output actually rises from 23% at decade's onset to 25% by decade's end. I know we Americans have some issues. We've seen some of that play out in the streets of America, during 2020. Fragmented politics, our crumbling infrastructure, our national debt. But somebody in this country, including chamber members, I suspect, is doing something right. Because we're home to less than 5% of the world's population and a quarter of its output. But does this performance, as remarkable as it is, justify this performance? This is stock market returns by country or region 2010 to 2019. Again, you may not have agreed with anything I've said thus far, or anything I will say in my remaining few minutes with you. But upon one thing we can agree, a decade has 10 years. So you take that American figure of 256%, divide it by 10. And you get a back of the envelope computation with respect to the per annum rate of return on you investing in US stocks each year for a decade. Compare that to India, a country that pre-COVID-19 during a bad year would grow 6% in real terms, or China, which has also a higher growth rate, including this year. But you wouldn't know it from a stock market performance. So whether I show it to you in absolute terms, price earnings ratio, or relative terms like I'm showing you here, the markets came in quite elevated. But the real reason that any economist who thought we could get through this without a recession was so naive was that COVID-19 is just different economically. So I've done the 9, I've done the 7, here comes the 3. It's just different. And to try to simplify their understanding of this crisis, many economists have tried to compare this to previous periods of American economic stress. So I've heard many economists compare this to October of 1987 from a stock market perspective, or to 9/11. Or to the effects of Hurricane Katrina on New Orleans in 2005. And of course, many have compared this to 2008, 2009. Most of that is sheer nonsense. I'll give you an example. 2008, 2009, that was a demand shock. What happened? The money disappeared. From where? Everywhere. Value of people's homes, value of their portfolios, bank balance sheets. The air came out of the balloon. So what did we do? We put air back in the balloon. We passed TARP. In late 2008 to try to recapitalize the banks. We passed the stimulus package in February of 2009, the Investment and the Recovery and Reinvestment Act of 2009, $787 billion package. The Federal Reserve reduced its interest rates effective to 0, and then again blew up its balance sheet from $800 billion pre-crisis to $4.5 trillion during that crisis. We put air back in the balloon, and you could argue it worked. For that fashioned the lengthiest economic expansion in American history without triggering problematic inflation. But this was no demand shock. This was a supply shock of a caliber unknown in modern times. This was quarantines, travel bans and restrictions, closure of public places, which triggers factory closures and all kinds of supply chain disruptions. Now, true, as you shut down the economy and you lose 20.8 million jobs in April, that triggers a follow-on demand shock. People losing jobs, losing confidence, so on and so forth. But first and foremost, this was a supply shock. In some sense, it did not matter how much momentum we had coming into the crisis. You take an economy, you shut it down, the economy recedes, you're in recession. It shrinks. Now, we have seen progress. And again, some more high frequency data for you. These data come out each and every week. So this is initial claims for unemployment insurance. So during the week ending October 31st, Halloween, the advanced figure for seasonally adjusted initial claims was 751,000, a decrease of 7,000 from the previous week. So you can see this red line is the crisis period. We had 25 million people on continuing claims at that point. We had, during the week ending March 28th, we had 6.9 million people filed for unemployment insurance in that 1 week, and then 6.5 million filed the next week. So the number of people actually on continuing claims continued to rise, and that's this slide, continuing claims. So you see that 25 million peak there in terms of the number of people on unemployment insurance. There's a separate program called Pandemic Unemployment Assistance, which includes a few million people. That's not reflected here. This is traditional unemployment insurance. But during the week ending October 24th, the advanced figure for seasonally adjusted insured unemployment was around 7.3 million, a decrease of 538,000 for the previous week. So, we have seen through October at least, and we now have the October jobs report, that the economy is making progress. You can see we peaked in April in terms of continuing claims, people on unemployment insurance, and we've come down a long way. Again, not complete recovery, but significant recovery. Again, if you flip the slide upside down, you get sort of an awkward V. And that's what this has been. It's been a V-shaped recovery. And some economists realized that it would be. And who are these economists? People who had studied history. Because we have some data regarding the economic impact of past pandemics. This comes from Goldman Sachs. Now, we're late in the presentation. I've hit you with a lot of data. I'm really putting you through the ringer. I get that. Just a couple more slides. And to simplify this one, I know there's a lot of lines on here, too many by half. But if you could just fix it on one line for me, as we hit the home stretch here. You see it's a blue line that goes way up to the top and back down again. Hong Kong, SARS, 2003. You see the skinny line at 0%? That is a stand-in for the pre-existing rate of economic growth. So what's going on here? As a pandemic strikes a society, growth goes below that pre-existing rate of economic growth. Well, of course it does. And then first the pandemic hits travel and tourism, financial markets, but then eventually hits manufacturing, construction, real estate, so on and so forth. So things get worse often before they get better. You can see that with that blue colored line. And then what happens? A sharp bounce back in economic activity. You again see the letter V. You see lots of V's on this chart. And one of the reasons that these recoveries tend to be V-shaped, at least the initial stages, is that governments don't just sit by and do nothing as their people are plagued by the plague. They do something. They stimulate the economy. To date, we've had 4 rounds of stimulus in America. The big one here is phase 3, the Coronavirus Aid, Relief, and Economic Security Act, the $2.2 trillion package. That's your $1,200 check. That's your Paycheck Protection Program, so on and so forth. But look, the last stimulus that we had in America, major stimulus coming from the federal government, major stimulus, was about 7 months ago. So this economy is effectively running naked into the winter. And that's not a good idea, especially not in bed. So we've got some issues here. The virus is surging. I know that we got great news from Pfizer recently. I understand that. A vaccine is part of our future, but we're going to get to dissemination of that vaccine. And by the way, it hasn't yet been approved. So you can hear one day, oh my goodness, we had some unexplained illnesses in that Pfizer sample, or Moderna, or Vir Pharmaceuticals, or others now in phase 3 clinical trials. So there's that. I'm still very optimistic, by the way, even though I might not sound like it, but I know that things can happen. Circumstances can change. Going forward, I'm not that worried about the demand side of the economy. I know that there are a lot of people who can't pay rent or are facing eviction. True. I know there's lots of food insecurity in America, people going to food pantries to eat. True. But as I said, there's another group of families who have been stockpiling cash. And how do we know that? We have data on the US savings rate. This is savings as a percentage of personal disposable income. Now, coming into the crisis, the US savings rate is around 8%. By April, you see a big peak there? It's 33%. Again, rewind. People getting money into the household, can't spend it, savings rate takes off. Now, as the economy reopens, people start spending that cash, and we see that surge in retail sales and inventory rebuilding. We talked about that. But as late as September, the savings rate is still a lofty 14%. A lot of families are in pretty good shape from a cash flow perspective. They've got cash on the balance sheet. So I'm not that worried about the demand side of the economy, at least macroeconomically. There's families out there who are hurting, of course, but from a big picture macroeconomic perspective, I'm not so worried about the demand side. What am I worried about? Final slide, the supply side. So this first bullet is a quote from my first set of webinars I delivered in March as all of my in-person presentations went remote, like maybe this one has gone. So I said the initial phase of recovery from the crisis will be sharp, profound, and most welcome. That's exactly what it has been. As people re-engaged the economy, they found interest rates to be ultra low. They had pent-up demand because they had not consumed a lot of things for a long time. There's a need, therefore, to rebuild inventories, which is part of that V-shaped recovery. And we're human beings. We're Americans. You're from Bend. And you're social beings. So you're anxious to meet again, go to restaurants. Some of you want to go to casinos. Nothing wrong with that, as long as you don't overdo it. You want to see a movie, and in a theater, with heavily buttered popcorn and salted popcorn and a gigantic Coke and Twizzlers. It's the American way. You don't want to necessarily watch on Netflix at home. Though if you're going to watch Netflix at home, might I recommend Indian matchmaking? Phenomenal. You want to watch the Orioles, which is the most phenomenal thing a human being can do short of nurturing a child, and engage in other most wonderful of human activities. For those of us economists who thought it was going to be a V-shaped initial phase of recovery, May's jobs report was the vindication. V for vindication, validation, vibrancy, vitality, and eventually vaccine, of course. And then June was even better. We had those, the 4.8 million jobs. But you'll notice that though we've been adding jobs in recent months, July through October, in general, the trend of job growth has been weakening in general. So while the recovery has begun, these remain obviously treacherous times. We haven't yet earned an enduring V-shaped recovery because unlike Hong Kong and SARS, the virus is back with a vengeance. And we're marching into the winter without much stimulus. Now, we might get stimulus soon. We'll see, whether during the lame duck session or after inauguration, but not now. It's not there now. So my baseline prediction is that we have another near-term recession, the V becomes a W, and that when we get that vaccine and that post-inauguration stimulus, watch out, 2021 is going to be an explosive year to the upside in terms of economic growth. That's going to be the real V, the unconstrained V, the time when you and I can be together at a business function. But until that time, we're going to see some softness in the economy, I'm afraid. The V becomes a W. And with that, thank you very much, Bend Chamber of Commerce. It has been a privilege to be with you today, and I look forward to talking to you further. Be well.
Welcome, live, Anirban. Mr. Basu, we are so thrilled to have you with us. How's the weather over there?
It's a bright, sunny day here in Baltimore, Maryland. It's cold, but it's bright and sunny, and of course, I'm indoors.
Well, we are no stranger to cold in Bend, Oregon, that's for sure. It sounds like you've been here before. So
I have. I've spoken there many times, actually, so yes.
Yeah, that's great. Well, we're so glad to have you back, even if it's virtual. Mr. Basu, we have a bunch of questions in our queue. And so what I'm going to do is read them off to you, and you and I will just interact here, and we'll go for about 25 minutes, because I know there's a lot of stuff that folks want to know and they want to pick your brain. So I'm going to get us kicked right off, okay? Great. So the first question from the audience is, what will be the biggest economic challenge post-COVID? So let's say it's this time next year. What do you see as the biggest challenge?
Oh, I think it's getting back to normal. So our behaviors have changed during this pandemic. I mean, there has been a meaningful transfer of wealth and economic power from smaller businesses to large businesses. So, a lot of us have, gone to the grocery store, and we go into our offices, so on and so forth. There's a life that we've become accustomed to. But now a lot of us have begun to order groceries online from very large enterprises, or we're buying from Amazon. Jeff Bezos got richer during this. I'm not saying that that's a bad thing, that's a good thing. That small business lost market share, large business gained market share. And to the extent that our COVID-19 behaviors are sticky, to the extent that they continue to be apparent even after this pandemic. I mean, we've heard big news from Pfizer and Moderna in the last couple of weeks on their vaccine candidates. What does that mean for small business? What does that mean for Main Street shopping? What does that mean for, millennials living in downtowns, whether in downtown Bend or wherever it happens to be? What does that mean for, office space consumption utilization? What does that mean for commercial tax bases? That's the biggest challenge, is trying to understand how much of our COVID-19 behaviors are sticky and will perpetuate themselves into the future.
Yes, I totally follow that. And this next question is kind of a follow-on to that. You touched on it. How quickly do you think the remaining jobs will return? And I know that's a tough one to answer because it depends on what type of job you're talking about. So in your perspective, what types of jobs will return and what types of jobs do you see falling out as a result of COVID?
Yeah, right. So great question. So look, as I said in the presentation, I hope I said it in the presentation, we're down 9.2 million jobs on a year-over-year basis in this country. And we've seen job losses in Bend and Oregon generally, and so on and so forth. So and a lot of the jobs have been lost in retail, hotels, restaurants. And then, of course, some have been lost, ironically, in healthcare because people have delayed elective surgeries and wellness visits to dentists and doctors alike. And so, lots of jobs lost. Now, again, it gets back to how quickly do we return to normal behavior? This economy has shown itself to be extraordinarily resilient. I mean, the early stages of recovery since May have been astonishing. As we open up the economy again, we create a lot of jobs. So we have that kind of potential. And my earnest belief is that once we get that vaccine at some point next year, that plus a post-inauguration stimulus will bring back a lot of jobs during the back half of 2021, if not sooner. So that's great. Now, complete recovery, my goodness, is that 2023, 2024? Your guess is as good as mine. But there will be some segments that will be permanently negatively impacted. I'll give you an example. The apartment market. At least urban apartment markets will be very negatively affected. The previous decade was about cities and millennials moving to cities, often renting newly constructed apartments in tall apartment buildings, paying top rent. This next decade will be about the suburbs. So that's an issue, obviously, for many, many cities. What about commercial real estate? If we learn that 37% of Americans can do their jobs completely from home, that has to have implications for the office market. But here's the thing. A lot of those workers have proven to be more productive working from home than in the office. And so what does that mean for office space construction going forward? What about hotel room construction? What about shopping center construction if more and more activity moves online? So commercial construction is one of the segments I think that'll be very challenging going forward. Meanwhile, e-commerce will continue to boom. Amazon will continue to get bigger.
So I want to ask this next question. It just keeps attaching on to what you just were sharing with us. So in Bend, we're experiencing a Zoom boom. So that means a lot of folks are moving here from all over the country. I know to my left and right on my street, there's somebody from Seattle and another one from Boston who just moved in within the last 3 months. So when you're looking at a Zoom boom economy, the number of house sales in Bend are demonstrably higher, as are the prices. So probably more so than other popular towns. I think we're the fastest growing city of our size in the nation. So who can we expect to be winners and losers in our region as the Zoom boom continues? And I'm not just talking about house sales. I think this person wants to know who will recover, who's going to thrive in the type of economy that is emerging in Bend, where people are working remotely.
Look, it's the kind of people who have the ability to work remotely. It's white collar professionals. By and large, they're the ones who tap away at computers all day. Oh, they do other things. They meet with other white collar professionals, for instance, but they can do that as well on Zoom. So they can do whatever they do in the office at home. And one of the things that's happened here is that this has widened the prevailing or pre-existing socioeconomic disparities. Who lost their jobs? People work in restaurants, hotels, for retailers, entry-level and near entry-level jobs. Who has benefited? The likes of Amazon and Apple and Intel and Applied Micro Devices and so on and so forth. So in some sense, the rich got richer. And the people who are struggling to get into the middle class, not so much. And so what does that mean for a place like Bend, Oregon? Well, enormous economic opportunity, because there is more opportunity to work remotely. And more people, by the way, are going to demand that from their employers. If people have been stuck in Seattle traffic at rush hour, or Portland, Oregon traffic, or San Francisco traffic, and now they're used to working from home, they're probably not going to be desirous of spending 5 days commuting to work, as they had been pre-crisis. They're going to demand from their employers, hey, let me work from home 2, 3, 4 days a week. I'll come in once in a while just to share some ideas with colleagues and so on and so forth, just to check the business's temperature. But and for some employees, they're going to say, I just want to work from home. I'm very productive. I'm more productive at home. I want to move to Bend. So what does that mean? The valuations of property in Bend, Oregon go up. This creates even more pressure on infrastructure to keep up, because that's been the primary issue for many people in Bend, is that the infrastructure has been faltering in the face of all of this growth. And of course, that's the sort of the pain of growth. But there's more growth ahead. But what also is ahead? Higher property values, higher cost of living. And Bend has a massive tourism industry. Tourism tends to employ entry-level and near entry-level types of people. Where are they going to live? How long are their commutes going to be? Because they can't work remotely. They have to deliver the service in person. So what happens in a place like Bend is the potential for a really unbalanced housing market. Fabulous for people of means, not so fabulous for the people actually doing the work in the community physically. So that's a big issue.
Yeah, and we'll be talking more about that tomorrow. We have another conference on real estate specifically, and I'm sure that we'll be finding a lot of that playing out on the realtor and construction end, as you shared with us. I'm going to move us on to another topic. A couple of questions about inflation, and I was watching your slide on what was happening with that. What's the forecast? And you, as I don't know, the wearer of the one ring, what do you see happening with inflation, and how does that impact the recovery?
So for me, the one ring is a wedding ring, as it turns out, and not quite as powerful as the Sauron's ring. Anyway, so inflation. So we have not had to worry about inflation in our country for about 40 years. Ever since Paul Volcker, the Federal Reserve Chairman during the early 1980s, stomped out inflation, driving the economy into 2 deep recessions in the process, it turns out, but really stomping down on inflation. 6'7" Paul Volcker, the tallest Federal Reserve Chairman in American history. We really have had this low inflationary environment that helped to support the economic booms of the 1980s, the 1990s, the housing boom of the 2000s, and then this most recent cycle. And it's really quite remarkable. 3.5% unemployment, we achieved pre-crisis, 50-year low, low inflation. Really fantastic. But the ingredients now for more significant inflation are now there. We have higher federal budget deficit spending. We've got enormous money supply generation by the Federal Reserve, which now has a balance sheet of $7.2 trillion. We will have at some point next year a massive global economic recovery as we move toward herd immunity because of Pfizer's, Moderna's, and other people's vaccines, Novavax, and whomever else comes up with a workable vaccine. I mean, Pfizer is looking for FDA approval in the next few days. So you put all that together, the deficit spending, the money supply creation. Here's another factor, supply chains buckling. So one of the things that we see is that more and more manufacturing is being moved to North America, including the United States. And that's wonderful for the American worker. I really believe that we want to have more manufacturing jobs in this country. But the typical American worker is far more expensive than the typical Chinese worker, Bangladeshi worker, or Mexican worker. That is inflationary. So you put all that stuff together, in 1 to 2 years, you and I might be talking about inflation for the first time in 4 decades as a real problem. And one of the things that would do is it would drive up interest rates. And our country is so leveraged. We have taken on so much debt that higher interest rates become very problematic, including for our federal government. So that's a concern. And it should be a concern for people in the stock market, but just business people generally who have benefited from a low cost of capital.
Okay. I've got a couple more questions here that I'm going to link together. I think they might help spur some conversation with you. Should businesses be concerned about national debt? And related to that, with the GDP at 2% impact, will that impact our ability to pay back that corporate, household, and national debt?
Right. So right now, the national debt is $27 trillion. I presume it's going to go up significantly during the current federal fiscal year because we're getting more stimulus. So last federal fiscal year, the one that ended on September 30th, we ran a $3.1 trillion annual federal budget deficit, equivalent to 15.2% of GDP. They're massive deficits. But it's not a problem until the bond market says it's a problem. When the bond market says we're not lending to you, federal government, anymore, then it becomes a problem. But today, The yield on the 10-year Treasury is around 0.865% last I checked. That's less than inflation. So people are bending over backwards to lend to the federal government for less than a percentage point. And so you can finance or refinance a lot of debt that way when you've got such low rates of interest. At what point will the bond vigilantes come out in force? You might remember what happened in Greece and Portugal a few years ago, in Spain and Italy and so on and so forth. What was the issue for them? They can't print money. They're in the Eurozone. They don't control the supply of euros. But we the Americans, control the supply of dollars. So there's three ways to deal with a bond market crisis. When the bond market steps up and says, we're not going to lend to you anymore, federal government, at these low rates of interest. Three things the government can do to avoid default. Number one, raise taxes. Number two, cut spending. Number three, print money. My guess is, based upon our past behavior, we're going to print money and pay down that debt. But we'll do it with devalued currency, which will cause future lenders to want to charge even more interest to the American government. So interest rates are headed higher. And at some point, of course, businesses should be worried about that, because if you're a real estate developer, or if you're a dealership, selling light trucks or cars, you depend heavily upon favorable interest rates to drive activity. If you're a home builder, but I think we're going to see more inflation and higher interest rates as part of our future. That's not necessarily a 2021 story, but at some point in our future, people have to be prepared for that.
Thank you. I'm going to shift the conversation now to higher ed. As you know, we have a university here, Oregon State University Cascades campus, as well as a community college, Central Oregon Community College. What do you see? This is a pretty loaded question. Are the long-term impacts of COVID-19 on higher ed?
Yeah, great question. So I think there's a number of them. I think a lot of young people have watched, let's say folks in high school right now have said, look what's happening right now. I can see, folks who are able to work remotely are being able to stay at home. They haven't lost their jobs as much. The data are suggesting that they're actually more productive working from home. And then I'm watching the folks who are, bagging groceries, having to deliver food, and keep this economy going, work in fulfillment centers. And they often make less money, and they're more exposed to COVID-19 and the dangers of this pandemic. And so I want to be on the right side of that line. I want to be one of these folks who, when this happens again, I'm not having to put myself at risk to do my job. So I actually think that a lot of young people will be induced into pursuing more higher education. I actually think that more young people will say, look, let me think about the trades, the skilled trades. I mean, what if I was a welder? What if I became a carpenter, an electrician, a plumber? What if I could be part of the American middle class that way? It's not something I would have considered before necessarily, but I want to be able to make a living so that I have some choices if this ever happens again. So I think actually, there's been a lot of talk about higher education will never be the same. A lot of universities are going to falter, so on and so forth. I don't agree. I think that some private liberal arts schools are in trouble financially. That's true. Because there's this notion that it's got to be STEM and it's got to be science, technology, engineering, math, so on and so forth. And I think state universities will do just fine, by the way, because they offer the better value proposition. Small liberal arts colleges, I think a liberal arts education, by the way, is a fabulous thing, but those small liberal arts colleges tend to be very expensive, and they don't necessarily have great reputational footprints. Often their reputation stretches within the boundaries of their own community, right? So these small liberal arts colleges dot the countryside. They're in trouble because people are not going to want to pay so much tuition necessarily to be in those contexts. The value proposition is in state universities and two-year colleges, and I think they're going to be just fine in terms of enrollment.
Thank you.
Probably Stanford will probably also survive. I think Stanford's going to make it. I think Harvard will probably survive as well.
Good to know. So I think we have time for at least one more question. I want to talk about the K-shaped recovery that we've all been hearing about. And early in your presentation that we heard today, you talked about what that recovery trajectory would look like in a V shape. And you also talked about Ben's propensity to have a lot of folks who are in the visitor-oriented lodging, et cetera, type of industry. Now, that's an industry that was pretty hard hit. And when you think about a K-shaped recovery, specifically economic recovery for Bend, Redmond, Central Oregon, in your view as an economist, what advice, what observations would you share with us in how to make the recovery here more of a V than a K?
Right. So these are you can actually have a V, or what will become, I think, a W-shaped recovery and a K-shaped recovery at the same time, as it turns out. So they're operating along two different dimensions. So the notion of a V is that we came back macroeconomically very quickly. We added back a lot of jobs. We drove down unemployment, not back to its previous low. 6.9% unemployment rate presently. As of October, we came in at 3.5%. So we're not back all the way, but meaningful recovery since April, when the unemployment rate was 14.7% nationally. But a K responds to the following. It responds to socioeconomic disparity. So imagine the letter K. But so there's a vertical line, of course, with the K, but there's two horizontal lines, one that's pointed up and one that's pointed down. But imagine that line that's pointed up doesn't start in the same place as the line that's pointed down. So this is a K in which the line that goes up starts at a higher spot on the vertical line than the line that goes down. And then what happens is, over the course of this recovery, this expansion, we have seen the wealthy get wealthier, and the people who work in entry-level and near entry-level jobs be put in enormous risk in terms of public health and in terms of job stability. So the wealthy have gotten wealthier. People who own assets, people who have significant stock holdings, wealthier. People who own homes, wealthier. People who rent apartments, facing eviction. That's what I'm talking about. So what is really good for the broader workforce, the folks who work in restaurants and hotels, so on and so forth, is for a really good economy. Because when the economy is good and employers are struggling to find enough workers who are service-oriented, that's when wages really take off, which is exactly what was happening prior to this pandemic. So what we really want to see is a very aggressive economic recovery. Get back to where we had been as quickly as possible. And yes, that might mean that we have to drive up the national debt even further. But that's much better than having a lot of these folks stay idle for months after month after month, and then potentially drop out of the workforce altogether because they just give up. They're discouraged. So that's the answer. But so far, we've had a V-shaped recovery, and it's also been a K-shaped recovery. The wealthy have gotten wealthier, near entry-level workers not as much. The hope, of course, is 2021 is somewhat different in that both of the lines go up.
Anirban Basu, it has been so great having you with us this morning. I'm going to give you one last 30-second question. What advice would you give the new administration, the Biden-Harris administration, in getting the economy on the right track as soon as they get in office?
Forget about the past as quickly as possible, right? If we keep focusing on the past, we can't get along. You did this, she did this, he said this, so on and so forth. You had this vote, we had that vote. Forget it. Start all over again. Tabula rasa. You're Republicans, we're Democrats. Let's shake hands. Let's start all over again. Let's help the American people come out of this sooner rather than later. So Biden is going to have to reach across the aisle. And by the way, he's just the person to do it. I mean, he's been a senator for a long time. He's been a bipartisan senator for quite some time. He's from Delaware. He's hardly someone who can't work with Republicans. Delaware is the closest thing we have on the East Coast to the Midwest. So he's a moderate Democrat. He can reach across the aisle. And if he does that, we can make progress in this country again, as we did under Reagan and Clinton, for instance.
Great. Thank you. And thank you for joining us live this morning. I know you're really busy. This was really rich with a lot of great information, and sure appreciate seeing you and hope we get to see you in real life someday soon. Thanks so much.
Thank you so much.
Thank you.